Well, what a morning it has been. On the one hand, you've got U.S. economic data, which would suggest the American economy is hanging in. That's encouraging. NVIDIA's quarterly results are strong enough to keep investors focusing on tech. The Canadian bank earnings looking respectable. But then we get a fresh post from the U.S. President Donald Trump, not long after us thinking, okay, now the tariff threat gets pushed out to April. He says, nope. We're back on for March tariffs, and what does an investor do? Let's ask Christine Tan. She's portfolio manager at Sun Life's SLGI Asset Management. Hello.
Good morning.
Any off days for you these days?
No, I always joke. Today is now day 1,382 of the Trump administration.
Yeah.
In terms of news flow.
Yeah, that's right. It's they pack a powerful punch, and I guess the question is for an investor: how much do you lean into all the noise? What do you do in an environment like this, do you think?
It's a great question. And we've been actually asked to speak to a lot of end investors because there's so much uncertainty just around the macro, like what should we do? And on the institutional side, for example, we do have clients who are CEOs of small businesses in Canada who are trying to think through tariffs, right? So,
which is a good point, by the way. There are a lot of people who watch BNN Bloomberg that have built successful small businesses, and they're trying to figure out what to do with that business while they've also got money in the market. There's a lot to think about.
Exactly, and this is part of the challenge. So our tariffs a negotiating tool, are they for real? And even on our team, we have that debate. So I'm going to try and talk about sort of one perspective that we have that seems to be playing out a little bit more, which is that Trump views tariffs in his second term fundamentally potentially different than in his first term. In his first term, it could be more about balancing trade. It was very specific. He went through the Section 232 of the Trade Act. This time around, he used fentanyl and illegal immigration to trigger the International Economic Emergency Powers Act, IEPA, which is not meant for tariffs. It's actually meant for sanctions for entities like Russia. But it was also not specifically carved out. So he's using that gray area. Why I think that's important to highlight is it fundamentally shows you that he's thinking broadly. So this is not looking at specific categories of goods to say, hey, John, you're producing steel at an uneconomic price, so therefore we want to target that. Having said that, there are tariffs on steel and aluminum that are coming, but this is a broader view, looking to balance off that budget spend that he just increased with the tax cut extension.
Right. Okay. So there's a lot we could chew off here, try to chew off, but I want to try to keep it as simple as possible. So I think it's fair to say the tariff threat is a real one for Canada's economy. So it triggers all sorts of questions around, well, what actually happens with tariffs?
Correct.
What does our central bank do? How do they react, respond? What does any interest rate response mean for also navigating inflation, especially because our Canadian dollar has been weakening during all this. So there's all of that. But then I see all this analysis if you're investing in the Canadian stock market. Even Bloomberg put out some data this week that said if you actually look at the companies that make up the TSX, there's a large majority that are less tied to physically moving things across the border.
Right.
Obviously, there's the energy component, but that the TSX may not feel the same immediate impact from tariffs outside of some of the psychological part. So I guess for anyone who's investing in Canada, in the equity market, what do you think about on that front?
That is the perfect question for investors, because you're right, parsing it apart from being the CEO of a business, there's that investor component. So what our managers, our underlying portfolio managers have been doing, because we hired them to select stocks for us, is really focusing on what business supply chains look like. So talking to their companies about where do you source all your goods, where do you export your goods, what's your exposure, and are there places where you can find a replacement? That's the discussion that's happening on right now. To your point, though, a lot of the publicly listed companies, let's say in Canada, they probably have some offsets. If you look at groceries, for example, we've been on this multi-week buy Canadian trend now, and clearly what the grocery companies are showing us is they're able to find alternatives for most goods, not necessarily all of them, especially in the produce segment, which we tended to rely a lot on the U.S. for.
By the way, this is just total opinion here, but
Yeah.
when you try to figure out where something is actually made in
Yes.
2025, whether you
It's
want to say
true.
it's technically from Canada or technically from the U.S., the further you pull
delve
back the
down,
onion,
yes.
you just end up deeper and deeper into a world wide web.
And that's what we learned. That's what we learned during COVID,
Yeah.
right? Because
Yeah,
the
very
company
true.
is saying there's this one ingredient that we're getting from Brazil. We can't get it right now.
Yeah, so let me ask you this then, because we, in the first 20 minutes of the show, we heard from a tech analyst who said you want to be looking at the big growth names, even if they're looking choppier at these elevated levels, because they offer you growth long term.
Right.
Then we spoke to a guest who said those gains may hold over the long term, but you still want diversification in the
Correct.
portfolio. We haven't even talked about the fixed income market. We're almost out of time because that's what we do here sometimes.
I know.
But I guess if you were to leave our audience with one thought on how to make a portfolio work these days, what would it be?
Stay diversified. So we lean towards the second. And we've been saying this for pretty much since the beginning of the year. And that means also having exposure to quality government bonds, because there is a real possibility we're going to see an economic slowdown if and when tariffs get implemented. And on the equity side, it was sort of lean with your second guess as well. Yes, tech is good, like it is a little bit more defensive, but as we saw with NVIDIA's earnings, you know, good versus great might also mean underperformance because they've come off such a stellar pace of earnings beats. And now it's just much more regular.
Really appreciate it, Christine. It's good to see you.
Good to see you.
Christine Tan is portfolio manager with SLGI